Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing KNOP Offshore Partners stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. KNOP Offshore Partners is a market leader in the operation of shuttle tankers. It operates 17 vessels with an average age of 7.8 years. Shuttle tankers have been proven to be safer than conventional crude oil tankers. Conventional tankers can only be used in calm waters. They load from offshore installations with assistance from tugboats to stay on location. Although shuttle tankers can operate independently in all water and weather conditions. Most of the world's oil is delivered using pipelines. But the benefit of using an oil tanker is that it's flexible, meaning it can pretty much deliver oil to any country in the world. Pipelines do not offer this convenience. It is possible to build pipelines beneath the sea, but there are locations where subsea pipelines are not possible. In the third quarter of last year, their fleet operated with 92% utilization. The way KNOP makes money is by leasing its ships to major oil and gas companies that are engaged in offshore production. For example, 3 of its ships are being leased out to Shell. This company is structured as a master limited partnership. MLPs pay a lot less taxes than a traditional corporation. It avoids double taxation. To qualify, the business must receive at least 90% of its revenue from natural resources or real estate. All dividends received from an MLP are taxed as ordinary incomes, which is the higher tax rate. Qualified dividends is the lower tax rate. When you receive dividends from a regular company like Microsoft, those dividends are taxed as qualified dividends, the lower tax rate. The company is headquartered in Aberdeen, UK, and was founded in 2013. It trades on the New York Stock Exchange and Deutsche Börse. Let's get started with the model. This is a small cap company, 534 million market cap. They're trading at $16 a share, and they have 34 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they have really consistent free cash flow, around $150 to $170 million a year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also pretty consistent, $60 to $80 million a year. Revenue is the sales for the company, and that's almost flat every single year, about $280 million. Here's their income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And that was the lowest in the trailing 12 months at $114 million. Below that is the operating expenses. These are the expenses not directly related to generating the revenue. And below that is their operating income. That was also lowest in the trailing 12 months at $107 million. They pay $24 million of interest on their debt, which is half the amount they paid in 2019, a little less than 2020. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. Below that is their pre-tax income, then their taxes. And this is why they became an MLP, so they don't have to pay much in taxes. You can see they pay hardly any taxes relative to their pre-tax income. And the bottom line of the income statement is their net income, which is positive every year. The big negative of becoming an MLP is that the company has to pay out at least 90% of their income back to their investors in the form of a dividend. That means there's really not much money for the company to grow, so they generally have to add debt if they want to buy new vessels. This is the company's income statement from their latest quarterly report, the first 9 months of 2020 and the first 9 months of 2021. They also have the third quarter of 2020, the second quarter of 2021, and the third quarter of 2021. So their revenue is down a little bit from $71 million in the third quarter of 2020 to $67 million. But you saw earlier their revenue is pretty much flat since 2018 because they lock in contracts with their lessees. So they're pretty much guaranteed to get paid regardless of the price of oil. They spent $18 million in vessel operating expenses. This includes fuel for the vessel, maintenance, and also the cost to pay the staff. $26 million of depreciation, $1.7 million of G&A, G&A would include the payroll of their corporate office, not the people on the vessel. Their operating income was $31 million last year, and now it's $21 million. The only reason it was negative in the second quarter was this write-down of $29 million. They reduced the value of a vessel on their balance sheet and then passed through the loss onto their income statement. Depreciation is for normal wear and tear of an asset. A write-down or impairment can occur if there's significant damage to the vessel, or maybe the market demand for that particular type of vessel changes. Those are just two examples of an impairment, but there's a lot of other things that can lead to asset impairment. They're paying more interest on their debt. It was $7.2 million. That's up from $6.6 million. And you can see they pay hardly any taxes. As a percent of their pre-tax income, it's very little. And the bottom line of the income statement is their net income, which is half from the third quarter of 2020. And the only reason it's negative in the second quarter is the write-down. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. This is why operating cash flow is so useful, because it smooths out all the accounting things on the income statement. Because that write-down is an accounting loss. It's a non-cash item, so it gets added back to the operating cash flow section. So you can see they generate sufficient amount of cash flow each year, and it's pretty steady since 2019. They spent $7 million in capex in the trailing 12 months. It doesn't look like they've been adding vessels the past few years, because even a used vessel costs a lot more than $7 million. Operating cash flow minus capex gives you your free cash flow, and that's pretty consistent each year. That's why they pay a really nice dividend. It looks like they're reducing their debt load a little bit each year. They repay a little more in debt than they issue. Especially in 2019, they paid $85 million and they didn't issue any. Here's their operating cash flows from their latest quarterly report, the first 9 months of 2020 and the first 9 months of 2021. And the way you calculate operating cash flow, you start with your net income, then you have to add or subtract the non-cash items on the income statement and adjust for changes in working capital. So we start with a net income of $31 million, we add back $74 million of depreciation, we add back that write-down of $29 million. The income statement uses accrual accounting, which is different from cash accounting. If you own a small business, you probably use cash accounting. But if you're a public company, you have to use accrual accounting. So that's why you see all these inflows and outflows. You see a positive $373 million of income taxes, a negative $83 million of income taxes. Then you see interest expenses, positive and negative. It's just adjusting for accrual accounting. And then you have changes in working capital. Nothing too significant here. Even though they reported an accounting profit of $31 million, they actually generated $121 million of cash flow. Here's their investing and financing section from their statement of cash flows. They received $444 million from long-term debt, and they paid down $480 million of debt. They paid $60 million in dividends. So in their financing section, they had a cash outflow of $100 million. Master limited partnerships don't have equity on their balance sheet. Since they don't have stockholders, they have unit holders, which are like partners. So if you own the stock, you're a partner of the company, a limited partner. If you look on the equity section of their balance sheet, they call it partner's capital. So I use $585 million as the equity number in my model because I need the equity number to calculate the price to book value and the ROE. And they raised $560 million from selling common stock. The general partner is not. They're the company that owns the MLP. And it looks like they created a second class, Class B. These are probably for insiders of the company so they can have more voting shares. Let's look at their capital structure. $600 million of equity, $1 billion of debt. They're 37% equity, 63% debt. And I gave them the highest WACC of 11.74%. That's the WACC on Simply Wall Street. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.7 billion. We divide that by 34 million shares. And we get a calculated stock price of $50. They're trading at $16, so they're trading at a 68% discount. It's a really strong buy according to the model. Their revenue is projected to increase 3.8%, so I grew at 3.8% for the next few years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, and I divided by these 4 revenue numbers. And that comes out to 57%. So I multiplied their future revenue estimates by 57%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $42. They're saying it's 62% undervalued. Here's a list of their 17 tankers. The average age per vessel is a little under 8 years, so it's a pretty young fleet. All vessels are leased out, and some of the lease contracts go out many years. Here's PetroChina up here. The vertically integrated oil and gas company in America, Shell, they own 3 ships. The Brazilian company Transpetro has 4 ships. The Spanish company Repsol, I did a video on them. They have 2 ships. The Italian company Eni has 2 ships. The Portuguese company Galp has 2 ships. The Norwegian company Equinor has 1 ship. The other Norwegian company Var Energy has 1 vessel. And 1 ship is being leased out to KNOP. Maybe the oil and gas company that leased this vessel, they want to remain private. This is the volume of oil transported by year by shuttle tankers. This goes back to 2010, and it's also forecasted in the future. So Brazil has the most oil, Norway is second largest, then the UK, then Russia. It looks like Canada has a little bit. The demand is expected to grow, which is good news for this company. The number of vessels in the market is highly correlated to the profitability of companies like this. The more vessels in the market, the less each vessel can earn per day. The less the number of vessels in the market, the more money each vessel could earn per day. It's just simple supply and demand. The problem is when the number of vessels gets low, then companies like this make really good money and they buy more vessels. And their competitors buy more vessels. And then companies like this may start to lose money because they can't demand as much money per voyage. So this company has 17 of the 100 vessels in the entire market. So they own 17% of the market. You can see this stock moves around a lot. It fell below $10 during the COVID crash. And then for almost 2 straight years, it increased to over $20. But then it crashed recently. Look at all this selling activity. Their third quarter earnings fell below analyst targets, so the stock crashed. But part of the reason their financials weren't so good in the third quarter is because they were transitioning some of their vessels from one lessee to another. It does appear the market overreacted, and there's proof of this because in the past 2 weeks there's been lots of buying activity, and it brought the stock price up from $12.50 up to close to $16. I was really shocked to see how consistent their cash flows are because almost every shipping company I looked at had really volatile earnings. Their numbers are pretty consistent, and I tweeted Stockaholics because he's an expert in this industry, and he said the company is avoiding the spot market. Their strategy is to negotiate rates on their own outside of the market rates. The benefit is if market prices are really volatile, they can mitigate that risk and receive more consistent revenue streams. There is some downside to this strategy as well. They do limit their upside, but it's kind of like hedging. When you hedge or when you buy insurance, you're protecting your downside, but you also limit your upside because when you get insurance, you have to pay for the insurance. You have to spend money. It's really impressive. They pay a 52-cent dividend every single quarter. And their dividend yield is amazing, 13%. Dividend comes out of their free cash flow, not their net income. So the payout ratio looks kind of crazy. Since dividend comes out of free cash flow, it's less than half of their free cash flow. So there is a decent chance they'll be able to continue paying this dividend payment. They've been paying 52 cents per quarter for 25 straight quarters. Their beta is 1.19, which is pretty surprising. I thought it would be a lot higher, because their stock price seems to be a bit volatile. The stock has gone down 13% in the past 52 weeks, but if you add the dividend, it's flat. And the S&P is up 25%. The 52-week low is 12, the high is 20. And the stock is trading between its 50-day and 200-day moving average. 200,000 shares are traded each day on this stock. Of the 34 million shares outstanding, 24 million are on float, 20% are held by institutions, and only 1/4% of the shares are shorted. If you invested $10,000 into this company when it started trading and reinvested the dividends, you'd have $17,000 today. That's a 6% annual return. The general public owns 54% of the company, public companies 27%, and institutions 19%. A Japanese shipping company owns 27% of the company, 9.3 million shares, valued at $148 million. Invesco owns 5%, then Renaissance Technology, Hightower, and Murray Asset. Let's look at their financial ratios. They have a really good price to earnings ratio of 9.6. That's stock price over earnings per share. The market median is 21, the average is 30. Their price to sales is 1.9, also better than the market median average. And most companies in this industry have a really good price to book. Theirs is 0.9, which is a phenomenal price to book. Anything below 1, it indicates that there's very little risk investing in the company because the assets are worth more than the market cap. Let's look at their non-current assets. The value of their vessels is $1.6 billion. That's the original cost of the vessels minus the depreciation. Right of use assets is $2.9 million, and accrued income is $1.8 million. A really low return on invested capital of 1.3%. They can only cover their interest payments one time. Their ROE is decent at 10%. They can only cover 70% of their current liabilities with their current assets. Let's look at their current assets. $67 million of cash, $2.4 million of inventory, and $11.7 million of other. Let's look at their current liabilities. $4.3 million of accounts payable. This is how much KNOP owes other companies. $5.5 million of accrued expenses. $88 million of debt. $9.7 million of derivative liabilities. $7 million of prepaid charter. This $7 million is probably a deposit for a voyage. They generated $155 million of free cash flow in the trailing 12 months, but they have negative $38 million of working capital. Working capital is current assets minus current liabilities, and their annual dividend payments are $70 million. So it does appear they generate enough cash flow to cover their expenses. The best way to look at ratios to compare them to companies in the same industry. There are 34 companies in the same industry as KNOP, and KNOP spends a lot less in CapEx than the average. They're more leveraged than the average company. They pay a massive dividend. Look at Starbulk, 22% dividend, and Zim, 17%. Some of these companies pay amazing dividends. Their free cash flow is pretty much average. They rank 13th in market cap, $534 million, average is $880 million. Their price to book, price to earnings, and price to free cash flow are much better than average. Their price to sales is worse than average. Their annual revenue was $279 million, average is $683 million. In the past 3 years, their revenue growth is flat, but their revenue did grow a lot from 2017 to 2018, so their 5-year annual growth rate is 10%, a little worse than average. And their ROA and ROE are better than average. So to summarize, I have them trading at a 68% discount, and it seems like this stock is trading at a great value. Plus the dividend is through the roof. And the reason the dividend yield is so high is because the stock price has come down. The lower the stock price, the higher the dividend. The higher the stock price, the lower the dividend. Because to calculate the dividend yield, it's the annual dividend payment over the market cap. Or you can just take the last dividend, multiply by 4, take that number, and divide by the current stock price. If you own this stock, I'm sure you're really happy getting that amazing dividend. And I think that's why most people invest in these stocks, is for that dividend. There's generally not as much upside for a high dividend paying company, because if they didn't pay that dividend, they would have that much more cash to grow the business, which will push the stock price higher. But when they give out that dividend, it's less cash in the business, which brings the stock price down. But this stock could be a hidden gem. It could be a great addition to your portfolio, and it seems like there could be some upside because the stock has come down quite a bit since their last earnings call. I rank their free cash flows and revenue 5 out of 10, their ratio is 10 out of 10, so let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.